Good afternoon. Hello, everybody. If you don't know me, my name is Amanda Ryba. I am the founder of the Illuminate Your Wealth community, and my goal really is to shed light on some of the strategies and concepts that wealthy people use to really stay wealthy and build wealth. And one of those is infinite or family banking. So I see Miss Teresa. Hello, Miss Teresa from Massachusetts. I'll be in Massachusetts here in the next couple weeks, but what I would love to know is if you have heard of infinite banking before. So if you have, drop maybe a 1 in the chat below if you have heard of infinite banking before. It is super, super popular, hot topic today on all social media platforms. So today we're going to talk a little bit about how it works, right? So again, if you're just joining us, infinite family banking, it's a buzzword that has been going around for the past couple years. Really, that concept has actually been around since the 1980s. It's been around for a very long time. It goes all the way back to a gentleman named Nelson Nash, person that actually first created that with whole life policies many, many moons ago. Nowadays, a lot of us are using permanent life insurance IUL policies to do infinite banking. So what is infinite banking, right? What is that? So infinite banking is the concept of leveraging the same dollar in two places at one time, right? Or essentially making money in two places at one time. We can do this with permanent life insurance, or which I personally like to use IULs. I'll explain why, but we can do this with permanent life insurance because of a couple different features that they have. So just to give you guys background, if you don't know what permanent life insurance is life insurance that is meant to last you for as long as you live. It doesn't ever expire. It doesn't ever run out. You'll literally have it forever. And there's different kinds of permanent life insurance. The original OG kind of permanent life insurance is whole life. That's actually where infinite banking kind of got its start. Then they came out with universal life, then variable universal life. Then I think people were sick and tired of losing money in their life insurance policies, so they came out with index universal life, which is the #1 product that we use today for infinite banking. So to break it down simply for you, all it is somebody purchasing a permanent life insurance product like an IUL, right? An index universal life. I'm gonna call it an IUL for the sake of this video. Somebody purchasing that. And then as you guys know, life insurance isn't free, right? It's gonna have a base cost to it. So whatever that cost is, the client's job is to overfund it, put in more money into that policy than what it costs to actually own it. And if you do that enough consistently, it's going to grow and build wealth inside that cash value policy that you have the ability to take out and loan to yourself for future use. Now, a really cool thing about leveraging life insurance products, specifically IULs, is the insurance companies will look at that cash value that you've built up inside your policy and extend to you a line of credit for that same exact amount, for about, I'll say realistically 90% of whatever that is, right? So they're going to extend this line of credit to you, and they're going to allow you to borrow from that line of credit for anything that you need, while your money stays inside your account growing and earning interest. So not to confuse you, I'm actually going to show you this. I would hope that some of you that are on here have probably seen this before, but I'm going to show you this in case you guys don't know, so you can get a concept for how these accounts grow. So you're going to go on a little tour of what I got going on here. So that's my water bottle. But this is basically how these accounts work, right? So when it comes to our money, there's basically 3 different ways we can choose to see it grow. We can go into anything that's considered fixed, variable, or indexed. So fixed, that's pretty simple, right? It's like our bank, we don't earn, we don't lose. Variable, this is anything that's in the market. So this is your 401ks, your IRAs, your variable universal life. You're going to see that money go up and down. And then your indexed accounts are anything that are kind of like a combination of fixed and variable put together. So when the market goes up, the account's going to grow. But when the market falls, that account value is going to get locked in and you don't lose anything. Up again, the account grows, down again, it falls, and you lock in. So you get upside growth, but with no downside risk. This is how the IULs grow. This is how the insurance policies grow. So while somebody's overfunding that account, the excess cash is going into their indexed account, earning interest based on the market, right? So, but without any risk of loss. So hopefully that's all making sense so far. Hold with me, you guys. So I'm actually going to show you guys a real live example that I ran to kind of explain the whole infinite banking thing. So if we look at this, example, hopefully this will help make some sense. I've got my charger going here, so I'm trying to also charge my phone at the same time. But this is actually a real live illustration of an IUL, of one that I would specifically say is designed for infinite banking. So the way these work is the more life insurance somebody gets, the more money they can put into the account. So let me see if I can scroll up a little bit. Okay, perfect. So this is an example for infinite banking, right? This is somebody that wants to put in $100,000 a year into this account. In order to do that, they would need to get $1.35 million in life insurance. So this number, face amount, that is your life insurance number. That dictates everything. The more life insurance you get, the more money you can put inside the account. The less life insurance you get, the less money you can put inside the account. So if their goal is infinite banking, that means they're trying to get the least amount of life insurance required for the most amount of money they want to put in per year to keep the cost down and give them access to cash quicker. So hopefully you guys are following me. So if we look over here, this is how these work. So this individual, 45 years old, male, healthy, non-smoker. That's a plug for my church, Echo Church. If you haven't heard of us, check us out. But this is going to show you how many years the account has been opened. This is going to show you how old the client is, right? Starting at 45 and up. Again, we're looking at a male, healthy, non-smoker, preferred health rating. Premium is how much money he's putting into the policy per year. So if he's putting in $100,000 a year every year over 5 years, obviously he would have put in a total of $500,000. This is going to show you the totals every 10 years. Hopefully you guys are following me so far. I always skip this middle section because this is just showing if we were earning a fixed rate of return of 3% every single year. So we're going to skip that because we're actually going to look at the ones that show some interest and are indexed. These ones we're going to show an average of 6.42% rate of return per year. I will be honest with you, these things average a lot higher. I have seen some of these accounts do more like 10, 12, 15% on average over a 30-year span. So this is being very, very conservative. And here though, here is where you're going to see the cash value growing, right? So accumulated value is how much cash this person has growing behind the life insurance. The surrender value is how much they have access to. So guys, year one, right? We have $90,000 inside the account. We have access to 57,000 of it. So what does that mean? If he wanted to go and access money out of the account, he can't get to the 90, he can get to the 57. Year two, he puts in another 200,000. His accumulated value is now at 187. So remember, this accumulated value category, this is going to be the number you contribute minus the cost to own the policy plus any interest that you earn. That's how they're figuring this number out. The surrender value is a percentage of this. Most insurance companies are going to have anywhere from a 10 to a 15-year surrender, which just means they don't give you access to all of your money for 10 or 15 years. This one that I'm looking at here gives you access after 10 years to all of your money. So it's a 10-year surrender. But really, after that first couple years, you have access to the majority of your money. And then your death benefit is going to be your accumulated value plus your death benefit, right? Plus the life insurance. That will all pay out to your family when you pass away if you set up to have an increasing death benefit, which is what you see here. So hopefully that makes sense so far. I think I've got a few of you on here. So if anybody has any questions, please feel free, drop them in the chat below and I'm happy to answer them. But now let's get to the topic at hand, which is infinite banking. How do we do infinite banking with this? Okay. Let's say this guy is putting in $100,000 a year for 5 years. That's $500,000 after 5 years. We look over here. After 5 years, the account accumulated value is at $515,000. The surrender value is at $494,000. That's pretty spot on. Usually what you'll see is if these accounts are properly structured where they're being max funded in the first 5 years, you're going to be at pretty much about a wash after that 5th year, which is great. Now what this means is he's put in $500,000 that's going to start growing and earning him interest. The insurance company is giving him access to a line of credit to up to 90% of this number, $494,000. So if he wants to go and borrow money out, let's say he wants to do it maybe in the 2nd or the 3rd year, right? He's got access to borrow this money out. Now let's say maybe he's a real estate investor and he wants to go get some money out to go invest in some real estate. Or maybe he's a business owner and he needs some money out to go and leverage and help expand his company. This is the category he has access to. Now, if this was your bank or if this was your 401k or if this was your brokerage account, you take money out, what's going to happen here? This number is going to go down, right? You're going to no longer have money in here growing and earning interest. You're interrupting your compound interest. But with IULs, with the whole concept of infinite banking and life insurance, here is how it actually works. So don't worry, I have this actually drawn up for you guys. I'm going to show you a real live example. Let me show you. Hold on. Here's how it works, right? So let's just say, again, $100,000 a year. But now let's say at the completion of the third year, let's say after the third year, he wants to take out $250,000 to go and buy some real estate, right? If we look over here on the right-hand side, you're going to see how this works. Now, this number went down, right? This number went down essentially, but here it is over here, your $250,000 that's coming out. You've got this number is showing if we were going to do a repayment to it. The key here is the cash value is still growing and earning interest. He hasn't lost anything, right? So your cash is still growing and compounding. Death benefit is still growing. None of the money has actually been removed from the account. This is more so a loan from the life insurance company, and there's no repayment agreement to that. So if he wants to not pay it back, right? He does not have to pay it back. This is just showing if he wanted to pay it back, but he doesn't ever have to pay this back. The key is, though, you don't ever want this policy to cancel or lapse. So depending on how much of a loan you're taking out and when, you may want to be mindful on paying that back. But the real exciting part is you don't ever actually have to pay the money back, right? You have the ability to have that out for as long as you need. Now, this insurance company, that ability to kind of have access to that line of credit, they are charging you right now 5% simple interest per year to do this. It's not too good to be true. It's just too good to be free. So most insurance companies, they're going to charge you something to have access to that line of credit. Average rate or average interest rate I see to borrow that money out is usually 5% right now. But what that means is, let's say he's paying 5% to borrow that money out. Well, if he's earning 7, 8, 9, 10% interest, he's earning positive interest on money that doesn't technically exist inside this policy, right? Because it's money that should, in theory, have been removed. But in reality, it's the insurance company loaning him money to go and do whatever he wants to do, finance his projects, and then pay it back slowly over time. So the whole concept of infinite banking is really just the ability to not have to actually deplete your account. And I'm going to try and put you guys back up here so I don't have to hold you. There you are. You're back up. But it's the ability to borrow money from your policy, leverage it, let it still grow and earn interest. And then if and when you're ready to pay back, you pay back, right? Now, be mindful that if you're going to leverage IULs to do this sort of thing like infinite banking, and you want to do it really quickly, you want to be max funding those policies from the very, very beginning. So you definitely want to make sure that you're working with a good life insurance agent that understands how these accounts work, how to set them up correctly, how to structure them to meet your goals, because everybody's goals are different. Yeah, I mean, realistically, it's a fantastic strategy, and it can work for so many different things. You just want to be mindful of when you're doing it, how you're doing it, and make sure that you're always working with an agent that understands it. But I think hands down, it's fantastic. And again, it can be done. You just need to make sure that, one, you can get approved for it, right? Because these are life insurance policies, so they do look into your age, your health history, and your background, criminal background. But if you can get approved for it, if you can maximize it in the first couple years, that's the key. I have had people ask me, well, why are we spreading the $500,000 out over 5 years? Why can't we just put it all in 1 year? Well, simple answer to that is you can, right? You could do that, but you would have to get 5 times the life insurance to do that. So instead of him getting 1.35 million in life insurance, we would probably have to get more like 7 or 8 million in life insurance, because again, the more life insurance you have, the more money you can put into the policy. The less life insurance you have, the less money you can put in. I see a question. Is it possible that you recommend max funding immediately because your commission is 100% plus 10% of excess? That's a great question. Honestly, I don't get paid any more if somebody were to max fund the policy from the very beginning or pay the very bare bones minimum. So the way it works on us as the agent side, I'm guessing you're a skeptical Sally there, Jake. And don't worry, I do not mind, because at the end of the day, this is people's money, right? And the most important thing is you're doing what you want it to do. You're putting it somewhere where it's going to work the best for you. I don't get paid anymore. And even if I do get paid on excess, it's so minor, it doesn't affect my life. Me recommending somebody to max fund their IUL, it benefits you 10 times, 100 times more than it will ever benefit me financially. I could really care less if you max fund it from a financial perspective for me. I recommend it because it's the best thing for the client in that specific situation. If I was after money in my bank account and if I was after money in my pocket, I would drastically increase the life insurance in this account and then just tell you to put in $100,000 a year and you'd have access to it. That's what a really crappy agent would do, somebody that's just at it for their commission. At the end of the day, offering a policy like this, where you're max funding it, least amount of life insurance, most amount of money going in, is me or other agents that are doing this taking a huge cut on our commission to be able to structure these correctly. But at the end of the day, the way I look at it is, we need to do the best thing for you, because if you're educated and you understand why we're doing it, me taking a cut of my commission, it's not going to be a big deal, because at the later down the road, we'll probably get referrals because you've been satisfied and you understand it and you're happy with it and you're comfortable sending people to us because you know we do the right thing. That's how I look at it. So no, I do not recommend it because I'm getting paid any more or any less. Again, I really don't get paid any more or any less if you max fund it or not. That's up to you. So, but I do think that they are fantastic strategies. I am willing to take a cut on my commission to be able to have this structured correctly for clients. Hopefully I answered your question there, Jake, and hopefully after seeing this video, you realize that, agents that are doing this correctly really are out there to do the best thing for clients, and not all of them are crappy. I'm guessing you probably had a bad experience, and I apologize for that. But yeah, I think it's a great strategy. Again, you got to be able to get approved for it. And at the end of the day, you want to make sure you're working with somebody that understands how to do it correctly. I've been in the game now for over 8 years, and I am very well trained on how to structure these accounts to grow cash value and work the way you guys want them to work. So if you like this video, if you like this live, let me know. It's going to be saved on my YouTube page. You can always go back and revisit it later. And please share it with anybody that you can think of that's been looking at things like infinite banking. I have been trying to go live at least once or twice a week with you guys and bring you different content and different ideas and different people too that can educate you besides just me. So again, I hope you all have a great rest of your day. This gives you a little bit of an idea on how these accounts work. And I look forward to talking with you guys sometime soon. Have a good one.